On today's hot sheet, I'm discussing the CPI report for February, Trump's changes to the fair housing mandate, and job openings and labor turnover survey. We also have mortgage application data for the last week. We are jam-packed. Today is Wednesday, March 12th, 2025. I am Byron Lazine, and the hot sheet starts now. Welcome into today's hot sheet. Good to have everybody with me. Let me know in the live chat, wherever you may be, which market you are tuning in from today. It's a pleasure to be with you guys. We do this show each and every Monday through Thursday. The markets are open. It's your only 24-hour look back on housing. Best way to support everything we do here on BAM YouTube is to subscribe to the channel. It's absolutely free. It's a free and easy way to support what we're doing. If you're enjoying the content, please hit subscribe, hit the notification bell, and consider sharing the hot sheet with someone who could benefit from a 24-hour look back on housing. There's a whole bunch going on economically. I mean, the economic news right now seems to be coming from a fire hose. It's coming from all angles. You have predictions, and I showcased, some of the stark differences. You had Mark Zandi from Moody's yesterday. I showed on the hot sheet saying recession at 35%, up from a 15% chance. You have some people calling recession at a 50% chance. Then on the other hand, we had Kathy Wood from ARK Investing saying, second half of the year, complete boom, calling deflationary in our future, calling the future deflationary. Well, speaking of inflation, we have this morning's report. CPI report, which is the report that Wall Street looks at. Wall Street hasn't been happy the last couple of weeks. Markets have been tanking on uncertainty as investors flock to safety. Good for us as we look at the housing market, because safety means, or something that's more practical means 10-year treasury. That's pushed the interest rates down. And we're watching that very closely as we've seen now a little bit of a tailwind on mortgage rates. And we're gonna look at how that's played out over the last week here before we end the show on the last mortgage, today's mortgage application update. But CPI, this is what Wall Street looks at, investors look at. It's not the Fed's favorite gauge for inflation, but this is one that the markets pay very close attention to. And CPI inflation now just released at 8:30 a.m. Eastern time this morning, hit 2.8% in February. That is lower than expectations. Remember, January, we had a hot CPI reading, higher than expected. Now, February, which was projected by a lot of banks to be lower, is also now lower than January, meaning is also now, with good news coming, lower than even expected. That's meaningful. You're seeing that the Dow has moved up. So Dow and NASDAQ, I like seeing it move up. I will admit, I bought some Tesla stock the other day just because I'm like, it's getting so low again. I'll just buy some of that. I know Trump bought a Tesla car yesterday. I was tempted to go out and get one of those new Ys, but I didn't do that. I just bought the stock instead. And now we're seeing that the Dow here on market open has jumped up, as well as NASDAQ and S&P. So markets are up, responding to this news, responding to this CPI report. All right, let's get into what we care about, and which is going to be the outlook of CPI as it relates to shelter. It's good news that overall down, down meaning lower than expected. 2.8% is still over the last 12 months. That's the all items index before any seasonal adjustment. It's still above the 2% target. All of that. But how's this now actually going to impact the shelter readings? Okay, so the index for shelter still made up nearly half of the monthly all items increase. So shelter still driving the vast majority of these increases. It went up 0.3% in February, It was offset by a 4-point decrease for airline fares and a 1% decline on the index for gasoline. So there was a decrease in gasoline index. The energy, though, index overall rose 0.2% despite that. Okay, so shelter now only moving up, or not only, but moving up 0.3 in February, did make up nearly half of the all items. Just in comparison to the all items increase here at 0.2 for the month of February, 0.5 was the January number. This is the lowest reading that we've had since October of 24. So considerable move down there on CPI. And here's a 12-month look at this. So, 3.2 February 2024, now at 2.8. This was lower than expected. Expectations being beat is always a good thing. So there's your 12-month look on CPI, February 24 to now February 2025, which is what today's data was released. All right. If we just take a look at shelter here over the past 6 months, you had a 0.5 on shelter in August, a 0.3 in September, a 0.4 in October, 0.3 in November, 0.3 December. Then we went to 0.4 last month, and now coming in at 0.3 unadjusted for the 12 months ending February 25. Shelter sitting at 4.2. And so shelter continuing again to drive a lot of these. And shelter makes up, I know it said almost half here on the report of all items index. If we take a look at how it's weighted overall, shelter is weighted at 35% here overall on the CPI report. If we go to rent of primary residence, that makes up 7% of that. That moved up 0.3 for that measurement. Owners equivalent rent of residence, this was over 26%, which is absolutely insane. Moved up 0.3. That's at a 4.4 for the year. That takes a while to move down. I had a conversation with Danielle Hale over our Knowledge Brokers podcast about owner's equivalent rent. It's a hard thing to defend. She did probably the best I've ever seen somebody defend it, but still there's, you listen to really, really smart people, analysts and economists. Owner's equivalent rent is an old, outdated metric. It doesn't compute real time. Like Realtor.com, Danielle Hale's chief economist, Realtor.com has real-time data on rents. They're showing that they're going down. Yet owner's equivalent is going to reflect like 1-year-old data. Think about it. 2 years ago, rents, were definitely more competitive than they are today. Okay. Rents have eased up, in almost every market. There's going to be some markets, obviously, where that isn't the case. The 12-month change here on shelter this is actually, if we go all the way back now 20 years on shelter, this is what it looks like in the CPI. Okay. So we've almost come back to pre-COVID levels on shelter, and there's still, and Powell will tell you this, there is still more room to go on shelter. As some of that data that we're talking about, that's lagging data comes in, we're going to see shelter continue to move down. It will get back to these pre-pandemic levels on inflation. Powell does not care about home prices. That's not what they're looking at here. So home price, this isn't a home price thing. This is shelter inflation. Now we're almost at pre-pandemic levels. We're really just above pre-pandemic levels. On shelter, we're in the high 3s, mid 3s, and we're sitting at 4.2. So almost there on shelter. There's your inflation report. This is going to be a little bit of a little wind in the administration sails. I mean, getting beat up, right? We talked yesterday. Trump said, "Don't look at the stock market." All of a sudden, Trump 2.0, don't look at the stock market. When certainly in Trump 1.0, there was a lot of look at the stock market. Why is that? I mentioned a little bit yesterday. He talked about the stock market so much in the first term. In the first term, the stock market did nothing but go up. Wall Street loved Trump 1.0. Wall Street not loving the second term. Look at the S&P 500 since Inauguration Day. Okay, since Inauguration Day, the S&P 500 had a little bit of a jump up and has since declined. Okay, not double digits yet, but certainly the last couple of weeks, Wall Street is getting uncomfortable. Okay, now when you're seeing, this exit from equities, from stocks. Okay, and remember, like, here's one of the arguments. Not everybody owns stocks, right? Like, a lot of wealthy people own stocks. I mean, I know boomers got a lot of money in stocks, but not everybody owns stocks. So, Trump 2.0 is potentially, this is one argument out there, thinking about Main Street versus Wall Street. If the equities are cooling off here, and there's some of this excess money that's been in Wall Street, in the stock market, now being extracted out, where's that money going? Well, that money's going to something that's safe, something that's a long-term 10-year treasury. Okay. What have we seen since the stock market has been cooling off, has been taking L's? We've seen the 10-year start to be more invested in, and we've seen the 10-year starting to decline. Now, Logan Motoshami over at Housing Wire doesn't believe it's really going to get low until labor market breaks, but with more demand on the 10-year, we're seeing interest rates decline. So when the argument is made that Trump cares more about Main Street, the lower interest rates impacts everyday families, everyday small businesses, all of that, more than what the Tesla stock is doing. Okay. As an example. So we're seeing the 10-year go down. It's pushing rates down. If the stock market was on fire these last couple weeks, the 10-year would probably be at 7.25, like we were a few weeks ago on the 30-year fixed. Okay. The 10-year probably be at 4.5. One of the theories that you'll start to probably hear on the other side of the fear of tariffs and the anxiety about Wall Street, one of the theories that you'll start to hear, this isn't a theory, but one of the things you might hear more of is in 12 months, there's $10 trillion that is coming due that we need to refinance, we being America. So, like, if you had a $10 million mortgage and in 12 months, you had to refinance the mortgage. Okay, you've got a $10 million mortgage. In 12 months, it must be refinanced. Okay, it's an adjustable rate, or there's a balloon happening in 12 months. You have to refinance it. And right now, the interest rates were 7.5, but there was a pathway to get them to 6 in 12 months. Would you take that pathway? Would you take some losses, unrealized losses on your stock portfolio over the next 12 months to get to a lower interest rate environment to refinance your debt and then just, sit on your stocks till they rebound? That's the argument that whatever, tariff, stocks going down, as long as it pushes rates down. Okay. The Fed's not going to cut. But what can the administration do? So this is just game theory. This is something that's out there. It's like anything they can do to push the long-term rates down to refinance the debt in 12 months, and also help Main Street, that voter base, in the meantime with lower interest rates. That's one theory. We'll see how it plays out. And obviously the market and the economy is going to be in hysteria every single day, watching that. But this is what Nick Timiro says on that from Wall Street Journal. Trump didn't inherit a flawless economy. Obviously, we looked at that all year last year. It was anything but flawless. It was one of the hardest real estate markets of all time in 2024. Solid growth and lofty stock values obscured a frozen housing sector and cooling job markets. But Wall Street now is the ones that are nervous, and those vulnerabilities could be amplified. Okay, Wall Street might take some L's, but the real estate sector might take some W's, which impacts a lot of Main Street families, right? If there's more transactions happening in real estate, well, there's more title work, there's more mortgage work, there's more inspection work, there's more attorney work, there's more landscaping work, there's more cleaners coming in and cleaning. There's a lot of different businesses that benefit when that market gets up and moving. And, unfortunately right now, it looks like Wall Street might be taking some of those L's and may not be happy with Trump. We'll see if they pressure Trump back into some of those 1.0 type of policies. All right. Speaking of President Trump's administration, Secretary Scott Turner for the U.S. Department of Housing and Urban Development, newly named Secretary Turner, is cutting red tape by terminating AFFH rule. Okay, so this action is going to restore zoning decisions to localities and increase access and supply of affordable housing. Okay, what does that mean? Today, Secretary Turner announced the U.S. Department of Housing and Urban HUD is going to terminate the Biden-era 2021 affirmatively furthering fair housing rule. So essentially cutting this costly red tape imposed on localities and returning decision-making power to local and state governments. Okay, well, a lot of the power on this is already in local and state. And so any power that the federal government had, they're saying we're giving it all to you, which is one of the reasons why I've always argued that the federal government doesn't have much influence on housing supply. They don't. A lot of it's going to come down to, what's going on at the local level, and zoning is a big part of that. So the Biden era rule was in effect a zoning tax, which fueled an increase in the cost and a decrease in the supply of affordable housing due to restrictions on local land. This is now obviously, the argument coming from Turner's office, which is, appointed obviously by number 47 here. Local and state governments understand the needs of their communities much better than bureaucrats in DC. Terminating this rule restores trust in local communities and property owners while protecting America's suburbs and neighborhood integrity. One of the interesting things is, and I talked about this briefly, I talked more specifically about one of the initiatives that were mentioned, but the NAR CEO just this past week, Nikia Wright, met with House Speaker Mike Johnson. I did talk about this. I talked probably a little bit more than what I'll talk about it here on the Real Word podcast. It's available on this YouTube channel as well as Apple and Spotify. But Nikia Wright, very nice photo op for the NAR CEO, met with Speaker Johnson. You see Hakeem Jeffries, which is the House Minority Leader, photographed there to the right. He met with, congressional leaders. She also brought the NAR Chief Advocacy Officer, Shannon McGain, with her. Okay. Nice photo op. That's great. But there's 4 legislations that they are reintroducing. Okay. So these have been introduced in the past and didn't get through. This is the one I talked about on More Homes on the Market Act. I think there's a way to make it a home run. I think this would be a total win if they got it through. This one in particular, but I'll just kind of skip over that one. This one is the one that's controversial and is kind of talking to, why state and local governments, while they'll say we need more affordable housing, won't actually make the policy changes required to get there, because you've heard of Not in My Backyard. NAR wants to reintroduce Yes in My Backyard, the YIMBY, YMBY Act, which would encourage state and local governments to remove barriers and housing development and implement pro-growth policies. Well, HUD is basically telling you, NAR, before you even went and met, that they don't care. They're sending it back to state and local governments. So this work here with the federal government on this one doesn't make any sense. Okay. It encourages state and local governments to consider a variety of methods. So, I mean, the news from HUD was out before NAR met with these leaders. I would have not even proposed that one. I would have focused on this one, more homes on the market, because this speaks to the Trump administration playbook. Okay. This is a tax cut on capital gain exclusion for principal residences, up from $250 to $500 for single filers and up $500 to $1 million for married couples. I would take this one step further. This would be like the only thing I'd focus on right now if I was NAR, top of the list. I would say also make the standing capital gain exclusion, the $250 for single and $500 for married. And I would offer that out for anybody on a second home, on one investment property, one second home. That would free up inventory. This one here, like if the difference of me selling my primary is because I'm going to make another 500,000, well then, on top of the 500,000 I was already able to exclude, we're talking about $1 million in exclusion. Doesn't sound like that's an affordable solution to me. But if I can save all the taxes on a second property investment, a little 2-unit, a little 3-unit, maybe I'm burnt out. I've owned this thing for 30 years. I've been self-managing. Maybe I've got a portfolio of 30 of them. Ooh, I can save I can get a $250,000 capital gain exclusion on one of them. Oh, I'll send that out to the market. That would introduce some inventory. I would focus on that. That is something that the federal government actually can do. Okay, you see that, but NAR doesn't get it. You see that the federal government is saying, hey, as it comes to zoning here, with these types of rules, the federal government doesn't want to be involved in it. Okay, that's what they're saying here on this rule. They're sending that back to state and local governments to deal with that. So anything that you're proposing to, try to convince the feds to impose on state and local governments, they're not interested in that, NAR. They're not interested in that, but they are interested in tax cuts, and they could spin that as, we're doing a tax cut based on selling your home. We're increasing the capital gain exclusion, and then we're adding inventory to the market. So we're solving two problems with one rule. It seems like an absolute home run if you push it, pitch it the right way. Of course, just to wrap up on the Turner news here with HUD, local and state governments understand the needs of the communities much better than DC. So doesn't want to be involved with this. By terminating the AFH rule, localities will no longer be required to complete onerous paperwork and drain their budgets to comply with extreme restrictive demands made up by the federal government. There is this Doge mindset that federal government workers, there's a lot of paper pushing, a lot of paperwork after paperwork after paperwork after paperwork, which creates a really slow process in anything that you're trying to get done with the federal government. It's like, I send this paper to this person, that paper to that person. As HUD returns to the original understanding and enforcement of the law without onerous compliance requirements, we can better serve rural, urban, tribal communities that need access to fair and affordable housing. We're aware of communities that have been neglected or negatively impacted due to the demands of these rules. So they're saying this was a terrible rule. We're getting rid of it. Of course, Fair Housing Act was passed as part of Civil Rights Act of 1968, prohibits housing discrimination, of course. And this rule that is now been ended here was introduced in 2015 under the Obama administration, expanded the role of federal government in the local zoning decisions, increasing the certification process, which does sound like one of those maybe red tape measures that can slow things down as there's more, kind of hoops to jump through. So you may see other information on this. Here's, CNN business headline spin on it. Trump administration backs off mandate addressing housing segregation and discrimination. I won't get into that article. You can imagine there was actually a paywall on that article from CNN, which is absolutely insane. I do believe CNN says, they are, the most trusted source for, news but they had a paywall on that. So you couldn't actually get that information. They actually don't want everybody accessing information like we believe at BAM, which is why we have no paywalls on nowbam.com. Use nowbam.com for all your real estate news needs. There's absolutely no paywalls because we actually do believe information should be accessible, especially when you're sourcing like CNN's sourcing just this new information that I read to you from HUD.gov. Okay. All right. We've got a jobs report here. Obviously, we're following jobs closely. Then we're going to get into this mortgage application report. Jobs, really important right now, because if the labor market breaks, then we know the 30-year fix is going to go down even more. That's kind of what many are waiting for, is a labor market break before we see the Fed really take strong action on rates. 97% chance that when the Fed meets next week, there will be no cut. According to CME Group, the number of job openings was little changed at 7.7 million in January. Okay, so this is job openings. This is the job openings JOLTS report here, just released this morning. The U.S. Bureau of Labor Statistics released that this morning. So hires held firm. So 7.7 million was number of job openings. That is up slightly. It was like 7.65 million on the last report. So job openings up slightly tells you that, hiring is not, tanking to any degree. We've come way off of that scary inflationary peak of 11 million job openings. But we did tick up here on the last report. So there's still demand for employment. Okay. So 7.7 million jobs open in January. I know the Department of Education is about to lay off half their employees. There's opportunities out there. So even as some of these government layoffs happen, there's a lot of jobs out there. 7.7 million job openings. Hires held at 5.4 million. And total separations were changed very little at 5.3. Okay, so really no change here on job openings. And the turnover rate on jobs is very little changed. So nothing really to note there. You do see the huge, obviously the COVID swing. But we got down January 2022 down to number of employed persons per job opening, a very low number. Unemployment still very, very low. Number of employed persons per job opening. Unemployment is very low. We're at basically a full unemployed person per job opening right now. So should be easy to solve that problem. Maybe it's not always as easy as the numbers would suggest, but those are, in fact, the numbers. All right, mortgage applications. What do those numbers look like? We've had a couple good weeks now of some tailwinds on the 30-year fix because of those investments in the 10-year Treasury. Mortgage applications increased 11.2% from the week earlier. Headline number is mortgage applications jump. They shoot up. More demand for mortgages as we move into the spring market. Okay. What does that 11.2% mean for new purchases? And how much does it mean for refinances? Refinance increased 16% from the previous week. It was 90% higher than the same week a year ago. But the big one that we care about that tells us about the spring purchase market is the purchase index. And that increased 7% from 1 week earlier. Very good jump on these numbers. It was also 4% higher than the same week 1 year ago. Mortgage rates declining for the 6th consecutive week. So rates are now showing some consistency of moving down. The 6.67 reading last week on the weekly was the lowest level since October 2024. Those applications increased. Obviously, they were up 31% from a year ago on total applications. It's according to MBA vice president and deputy chief economist. And we're entering now this spring home buying season. So it couldn't be better timing for the market as we enter the home buying season. The purchase index was 4% higher than a year ago, as mentioned. So there you go. As we look at kind of where we're at on this big picture, still, long way to go. We can go back to 1995. You can really, with this little jump up, we touched down at this level in 2015 and 2012-ish, 2011-ish. Got to go back to really 95 to, get to these levels prior to that on mortgage application on the purchase side anyways. And we've been bouncing around these levels for, you got to go back to 93, 2, 4, 5 to see, any consistency like you do right now, a couple year run at these levels, even in the recovery years of 12 and 14, 15, we just touched down on these numbers and then kind of picked back up. So future's bright, I would say, on, mortgage rates here. We're seeing now signs of that being the case. We're seeing potentially, with all the fear out there, we're seeing maybe some of the reasons why these tariffs are being imposed, some of the reasons why Trump said the other day, don't worry about the stock market. Like he might be thinking, he might be gaming this, where if the stock market goes down, it's good for long-term rates. And that's ultimately what he wants. Helps Main Street. They've got $10 trillion coming due in 12 months. Just ask yourself, what would you do if you had not 10 trillion, but say you had $10 million you had to refinance in 12 months. Would you do everything to get a lower rate over the next 12 months that you possibly could? Ray Dalio, by the way, if you guys follow Ray Dalio, he'll make you not want to get out of bed in the morning. Let me find this from Dalio. You start, the worst thing you can do is like wake up at 4, not saying I did this morning. You could wake up at 4:15 in the morning and start reading Ray Dalio comments. You don't want to get out of bed. Okay. He's like, the mounting U.S. debt problem could lead to shocking developments. Imagine if that's the first thing you see in the morning, shocking developments. I don't want any developments that are shocking. Makes it sound like the end of the world. Okay. He says the first thing is the debt issue. Okay. We have a severe debt issue. And so, if the 10 years at 5 or 6 in a year when we got to refinance this debt, that's going to be a huge problemo for America. It's going to be a huge problemo for the U.S. economy. Who's going to want to buy our debt? And at those rates. Now, if you get that 10-year down at 3.5, okay, might be able to work with that. So maybe some of this stuff, the fear and anxiety. If you watch your, stock app all day long, then yeah, it's going to be easy to be worried. If you're not a seller of equities, right now, then you ride it out. Wall Street doesn't like this, what's going on. But it's pretty clear that it has been impactful for long-term rates so far early on. These things are like I've said before, tariffs are like a light switch and all of that. Now the 10-year treasury, we've seen a good 3 months, but we're not seeing that great of a day today. Why? Because equities are back up. The stock market is back up a little bit today. Not all of the L's have been recovered, but the stock market's up because the inflation news was good. Okay, so some people moving money back into the equity market, not as much going into the 10-year. You're seeing it now tick back up over 4.31. We could have our highest 30-year fixed reading in the last couple of weeks. 6.79 was the reading yesterday. It did tick up a little bit. Might be in the 6.8. I don't know. We'll see what happens. Nobody knows. But the 10-year is up here a little bit to start the day. Okay, there's your hot sheet for today. To get the most out of what we do at BAM, make sure you join us inside of BAMX. It's on school.com/BAMX to sign up. We'll put a link down below so you can do that. We just moved over the community to School. It's the #1 community and education platform, training platform in the world. And you get access to all of the hot sheet show notes, as well as all of our slides from each and every single show cut out for you, as well as the hot sheet show notes. How we make the cake each and every single day is inside of that classroom there on BAMX, as well as all of our other content, done for you content each and every single week is dropped right into here. You get templates along with all of your email scripts, video scripts, all new and updated each and every single week. And today we have, not only do we have a public webinar, this webinar is absolutely free to anybody. The link will be down below. Join Chris Benjamin at 2 p.m. today. This is free, open to everybody, BAMX member or not. Turn every listing into 5 deals. And then BAMX members are going to be able to join Chris in the after party. So public webinar, 2 o'clock, after party, after hours for BAMX members starts at 3. So also a link down below for the Chris Benjamin public webinar happening at 2. If you want to join the after party and all the other stuff we do inside of BAMX, go to school.com/BAMX. All right, there you go. There's your hot sheet for today. I hope everybody has a great Wednesday. We'll see you back here. Well, hopefully we'll see you at 2 o'clock on the public webinar. And then after that, we'll see you back here tomorrow morning. Until then, of course, toodaloo.